The time has finally come, and there's been some big changes to SCHD's portfolio. SCHD's annual reconstitution caused it to drop 22 companies and pick up 25 new names. And I'll be diving into the details of what's changed in SCHD's portfolio, along with what to expect from SCHD in the future. So let's get right to it. This video is for educational purposes only. This is not financial advice, and I'm not a financial advisor. All investments carry risks, so always be sure to do your own research. Okay, so before jumping into the actual changes, let's quickly go over how SCHD's reconstitution process works. So SCHD tracks the Dow Jones US Dividend 100 Index, which invests in companies with a track record of consistently growing and paying dividends. And the companies that SCHD picks goes through a variety of screening filters. First is that a company needs to have paid dividends for at least 10 consecutive years. It also must have a 3-month average daily trading volume of at least $2 million and a market cap of at least $500 million. From there, the companies are going to be ranked by indicated annual dividend yield, and the top 50% are eligible for selection. Then, the companies are ranked using a composite score based on 4 different factors. First is indicated annual dividend yield, 5-year dividend growth rate, return on equity, and free cash flow to total debt ratio. From here, the top 100 ranked stocks by composite score are going to be selected for the index. There's limitations in place that no individual stock can make up more than 4% of the index, and no single sector can make up more than 25% of the index. For stocks that are currently in the index, they can remain if they rank in the top 200 by composite score. So, a very specific and strict screening process allows SCHD to choose high-quality dividend payers. Alright, so now let's talk about what actually changed in SCHD this year. The reconstitution this year for SCHD came with the removal of 22 stocks and the addition of 25 new stocks, which is a bigger change than what we saw last year. And there's some pretty interesting names that we have in the lineup. As for the stocks that SCHD dropped, it included Cisco, which made up a little over 3.5%. And since Cisco performed pretty well over this last year, its dividend yield did drop and the dividend growth was lower than before, which I think was one of the main reasons why it was cut. Next up is AbbVie, which did pretty decent for the year, which caused the dividend yield to lower some, and if you also consider its high return on equity, it makes me think that was a big reason why it didn't make the cut. Another cut being Valero Energy that made up a little under 3%, and simply put, it was dropped due to its amazing returns over the last year, which drove the yield below 2%. This is from the increase in crack spreads and the turmoil in the Middle East being a major driver, which for the last of the largest weight holdings, Halliburton also benefited from the energy run-up, and then you have other small names like CF Industries, Amcor, Unum Group, Radian, and a few others. Getting to what was added, up top we have United Health, Abbott Labs, Procter & Gamble, Qualcomm, Accenture, Comcast, Blackstone, and more, and there are quite a few other smaller allocations to names and financials. But let's talk a little bit about the bigger additions to SCHD. The first one being UNH, which is United Health Group, and it was added with the largest weight of the newcomers at 4%. One of the biggest things to point out with UNH is that it took a massive hit, with it being down over 40% in the last year. This drop allowed it to show up on SCHD's radar as it had a dividend yield at around 1.6% or so before the price dropped, and by the time March came around, it hovered around 3%. The other dividend metrics are pretty solid as well, as it has a 5-year dividend growth rate of around 12%, 25 consecutive years of dividends, and 16 consecutive years of dividend growth. So it's no wonder why it was picked up by SCHD, as it's a solid company that's experiencing a rough patch that was picked up at a discount. As for growth for UNH in the near term, we'll just have to wait and see, as the revenue guidance is still a little bit lower than 2025 levels, and currently the company looks to be on the early point of turning around the business. The next ticker is ABT, which is Abbott Labs. This is another company in the healthcare sector dealing with medical devices, diagnostics, and medicines, which came in at around 3.95% weight. Like UNH, this is a stock that's also been facing a decline, even more so into 2026 of over 20%. The larger price drop in 2026 led the dividend yield of Abbott to jump up pretty quickly in a short time frame. But now it has a dividend yield of over 2%, a 5-year dividend growth rate of nearly 9.5%, 36 years of consecutive dividend payments, and then 12 years of consecutive dividend growth. This is great to see as an addition to SCHD. While the company is currently facing some shorter-term troubles, it has pretty solid cash flows and balance sheet, and has potential with the growing global healthcare demand. Now, this is a name that you're likely familiar with, and that's ticker symbol PG, Procter & Gamble. This stock came in at 3.81% weight, and if you don't know what P&G does, they sell a wide variety of consumer goods, like Gillette razors, Tide laundry detergent, Pampers diapers, Crest toothpaste, and so many other brands that you've either seen or used before. So first off, P&G is a dividend king, and those are companies that have grown their dividends for at least 50 years. Procter & Gamble has had 135 years of dividend payments, along with 69 years of consecutive dividend growth, so it's a beast when it comes to the dividends. With that being said, it's a pretty defensive and resilient holding for SCHD, since regardless of how the economy or market is doing, they're offering everyday products that people use and need. The last one to mention is ticker QCOM, which is Qualcomm. This stock was added with a 3.76% weight, and this company falls into the technology sector since their business revolves around semiconductors, wireless communications, and the Internet of Things technologies. Now, this isn't some speculative technology name, but instead a solid cash-generating company with 22 consecutive years of dividend payments and dividend growth. It also currently has a dividend yield of 2.8% and a 5-year dividend growth rate of 6.5%, which makes this a nice addition to SCHD's portfolio and brings in some tech exposure to the fund. So now let's zoom out and see how this plays into the sector exposure of this fund. In 2025, the big jump in exposure to energy shocked many investors, but this time around it's a bit less dramatic. And here's how the 2026 sector exposure shifted for the Reconstitution. Healthcare had a nearly 4% bump from 15.4% to 18.9%, which is going to be due to the big additions of United Health and Abbott Labs. Technology also had a bump of about 3.4%, putting technology now in the double digits. While Cisco Systems was one of SCHD's largest tech holdings that were dropped at 3.65% weight, it was replaced by Qualcomm and Accenture, which combined are over 7% of the fund. And the increase that you see in the communication sector is just from one stock being added, which was Comcast. Then there's a few other small changes between consumer staples, financials, and other sectors. Materials had dropped 3% because there were around 6 stocks in that sector that were kicked out. And the biggest change we saw was in energy, which dropped 7.1% from 23.5% to 16.3%. This is a pretty big change, but shouldn't be too much of a surprise when you take a look at how much the energy sector overall had gone up in 2026 by the time that March came around, and this was quite a big run-up. Like I mentioned earlier, Valero Energy and Halliburton were dropped, along with Devon Energy, which all experienced some pretty big run-ups and large decreases to their dividend yields over the last year. And I think the drop in energy just happened to be pretty good timing. I say that because SCHD was able to take advantage of a majority of the gains that the energy sector experienced before much more volatility arrived due to the Middle East conflict. And since we don't know if things will resolve or continue, energy could go on a wild ride in either direction. So I just prefer that SCHD is less exposed here, especially since the sector has already gone up quite a bit. But overall, this reconstitution brought in a little more balance to the portfolio compared to last year, and most importantly, SCHD is still tilted towards solid, defensive, and quality names. Now let's talk about the possible future outlook of SCHD over the short and long term. First, I want to talk about the current market and a few things that could affect SCHD in the short term. The most obvious one here is going to be the ongoing conflict with Iran. This conflict is causing oil to spike as much as $110 a barrel and ultimately creating inflationary pressure and fears. Higher energy prices and higher inflation will affect consumer prices, profit margins, and a variety of other issues that would overall hurt economic growth. And while SCHD has lower energy exposure than it did before, it's still around 16%, which is pretty meaningful, and names like Chevron and ConocoPhillips benefit from higher oil prices. Also, consumer defensive is now the largest sector for SCHD, and this is another sector that can provide some protection and cushion when there's pressure in the macro environment. Now, this doesn't make SCHD immune to drawdowns or a worsening economy, but due to the fund's nature and holdings, it can provide some protection and steady dividend income. Next is an issue that didn't escalate until the conflict, and that's possible interest rate hikes. Before any escalations, there was the expectation of 2 rate cuts for the year, but that quickly changed, and as of now, the expectation is none. These issues still impact the stocks of SCHD, but it's reassuring to note that the fund leans on resilient, high-quality, cash flow generating companies, making this an ETF that's better at riding the waves of the market. And when rates come down, investors tend to shift to dividend funds like SCHD that are low risk, since they won't get those same returns that they had in the past from their lower risk fixed income investments. This next one would be if the Middle East conflict ends very soon and the market flips back to risk on. Now, this isn't something that would necessarily hurt SCHD, but it would be possible for SCHD to be stagnant for some time. I say this because if things get resolved and the market sentiment does a 180, some of that steam that SCHD built up this year could get trimmed some. Oil prices would start to come down, and I could see a transition out of the more defensive and safer stocks to those with more growth opportunities that have been beaten down. And in this case, you'd see SCHD underperform the growthier leaning funds, which is to be expected. Now, this is just a possible scenario, but it's impossible to predict if things will turn around right away or not. Now, looking at the bigger picture for the long term, there's a few things as well, but it's much simpler. First of all, as a long-term investor, you shouldn't be bothered by the day-to-day movements of the market or what necessarily happens from one month to another. And that's because if you're dollar cost averaging, you're buying whether the market's going up or down, so either way over the long term, you're coming out on top. But I do think it's wise to have at least a small idea of what's going on around us, since certain periods of time there can be better opportunities for buying SCHD or any other type of funds. Now, I don't have a crystal ball, but I can at least bet that SCHD is going to continue doing what it should be doing into the future. I say that with confidence since the fund simply follows the strategy of selecting quality dividend companies and providing stable returns and dividends over the long run. There will be periods of time where it will underperform the broader market and growth funds, and times that it may outperform them. That's not the goal of the fund and just how things work out, but one thing you can count on is the solid strategy of the fund. And if you want to go deeper and build a portfolio that includes SCHD, be sure to check out this video here on the 2 best ETFs to combine with SCHD, or this video here on some of the best dividend ETFs. If you made it to the end, thank you for watching, and don't forget to tap that like button and subscribe. Keep on investing, and I'll see you soon.